And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Thank you for joining my podcast today, Tuesday, 6/30/26. Well, you know, it's interesting, the stock market on Friday, the economy stocks started to rally for the wrong reasons. Monday, pre-market was very strong. And the jibber-jabbers on TV, the financial jibber-jabbers, came on telling us how we're going to continue this rally, okay, what we call an economy rally, economy stocks, you know, industrials and so forth, and materials, and, you know, oil, those things. And I said, no, it's not going to happen, because you look at the two-year Treasury yield, the two-year was just not performing, and it's just not going to help. And so in the 10-year, same thing, they weren't dropping enough. So that was a bunch of nonsense that we were going to stay, because remember, everybody jumped out of tech and went into economy stocks, and they even went to the banks. But now they jumped back to the tech stocks. And the reason is because Wall Street gives you the wrong signals, because they don't want you to know what's going on. They want to direct you to what stocks they want you to buy. So they don't explain how the market works. So I'm going to explain a little bit of that today and what's going on right now, okay? But first, let's talk about, I listened to this guy here. Why don't we just play the cut?
We look at the consumer spending. We talked about it, money in accounts, credit quality good, equity in our home strong, a lot of good fundamental things. That's going to come down to labor and wage growth. If you look at small businesses, they're doing a pretty good job of earning money.
Yeah, 67% of small businesses file for bankruptcy. Yeah, they're really doing a good job. This is the job of the TV jibber-jabber, to take fundamentals and use them. I'm talking about the PE ratios, price to sales, price to book, you know, return on equity. Pick up one of those, create a story, and make everything look good and sound good. And that's what they're doing. But the truth is, before I get into the stocks, are we going to hold this tech rally or are we going to rotate out of it? They keep saying the consumer is strong. These people have money in their accounts, right? Good credit scores, home equity. Well, first of all, I always have to laugh at home equity, because that's nonsense, because none of that's telling you about the consumer's health right now, today. It's just telling you they haven't hit the skids yet. They haven't hit the wall yet. It's all it's telling you. What are they, nuts? I mean, this guy who's saying this is just nuts. Look, you got to look at what actually matters. And people are feeling much worse about their job market than any time in 5 years. Think about that. 5 years. They say, no, this is the worst job market. I haven't felt this bad in 5 years. More people say jobs are hard to get. Now, you get plenty of service jobs, low-paying, part-time jobs, service jobs, terrible jobs that nobody wants. You can get plenty of those, but you can't get a good-paying job with benefits. It's almost impossible today. Confidence is totally collapsing in the job market, especially good-paying jobs. It just collapsed, in fact. So that's our real economy, but nobody's telling you the truth. Savings are shrinking. Credit card balances are hitting record high. All the credit cards are tapped out. Delinquencies, we haven't seen these kind of delinquency in credit cards. We haven't seen these kind of delinquency in automobiles. God, they're stretching out the payments now. Pretty soon they'll be putting a 20-year mortgage on a car. And we never seen the amount of people that we see today that are using buy now and pay and you know, buy now, pay later to buy groceries. We've never seen this. So, home equity, that's a joke. It doesn't pay the bills. You just get deeper in debt. When you take your home equity, you're killing your retirement. The more equity you pull out of your house. Now, I mean, sometimes you just have to, okay? A good credit score doesn't mean you're not drowning. People, I got good credit score. What does it mean they're not suffering, they're not drowning? Bottom line, the consumer isn't strong. Don't listen to the jibber jabbers. The consumer's stretched, and the data tells us that. They're stretched, not strength like this dope has been telling us. Okay, so the jibber jabbers, these TV jibber jabbers. Now, as I tell you, they create stories. That's supposed to stop in 2008. After 2008 crash, I told you before, when they took a look at the $50 billion newsletter industry, it identified that they were part of the cause of the crash because they were directing people in their newsletters to stocks that were wrong, because the newsletters are written to help Wall Street, not you. And after that 2008 crash, the industry, as I told you before, dropped from 50 billion down to 5 billion. So Wall Street storytelling days were over. The market wasn't being driven by hype anymore. It was being driven by giant institutions because the Federal Reserve got together with Congress, with regulators, and they printed $18 trillion. And they said, you're going to fuel the market. Wall Street, sit on your butts. No more are you going to create stories. Well, they still create stories every day. It's all BS, but they can't move the markets. Now, I want to talk about that, okay, the market. So, as I said, you've got to stop listening to these storytellers. And again, if you keep listening to these storytellers, things are just going to get worse. That's all. So let's get on to the question everybody's asking. Monday, they said, is this rally from Friday going to continue? Is this tech rally going to continue? I mean, this economy, this the rally that was made up of economy stocks, like industrial stocks and material stocks and energy stocks. Okay, was that rally going to continue? And the jibber jabbers on TV were saying yes. I said no. The 2-year Treasury told you it wasn't going to continue. Now, so they kept telling a story why the economy stocks would keep on moving. This was Monday. Well, when the market opened, the economy stocks went down, and everybody rolled into tech stocks. So traders rotated back to tech stocks, especially the 4 stocks that drive this market. Those are the tech machine making stocks, okay? The companies, there's 4 companies that make the machines, that make the chips. Those are the leaders. They're holding the whole stock market up. So now traders are asking, now we're back into tech, a snapback. Is this going to hold? Well, no. See, the problem is the TV jibber jabbers never explain how the market works, because they don't want you to know how it works so they can manipulate you. They want you to depend on them and their storytelling so they can sell you the stocks that they make money in, and that comes from the stories they create from fundamentals that I told you a million times. So as long as you listen to their stories, they're going to sell the stocks to you that they bought first wholesale and mark it up to you at retail. Now, let's get to the tech. Now, this rally that we were having, so-called rally, is not the typical rally. These stocks, the tech stocks, are going up nicely, but for the wrong reason. This is called an increased liquidity move. That's what it's called on Wall Street with the professionals. This is not demand. This is about liquidity. Now, what's all that mean? Well, first, the last 2 days, the tech stocks, especially the 4 big stocks, the machine-making stocks, and the people who buy these machine stocks, okay, they didn't go on any buying spree like Wall Street wants you to believe. It was caused by a liquidity relief. Now, what's a liquidity relief? What's that really mean? Well, let me explain. What drives the entire stock market and the bond market, and I told you this before, is a $50 trillion lake of money. Think of it as a big lake. Now, that's pensions, all pension money put into, think, a lake, okay? Corporate pensions like Ford employees, GM, UPS, IBM, all into this lake. Also included in that lake of 50 trillion, 401ks, IRA money, millions of savers, all their money, insurers, their money, sovereign wealth funds, their money, teachers unions, 401ks, IRAs, and millions of savers. That's all in this big lake, 50 trillion. Now, that's managed by who? By JP Morgan, Citi, Goldman Sachs, hedge funds, Vanguard, Fidelity, PIMCO, all of these people. Okay? Now, they manage that money that went into the pool because of your 401k, your IRA, and your savings. They manage that money, 50 trillion in the pool. They don't own it, they manage it. Now, who has access to that 50 trillion lake of money? Now, remember, who has that access to that lake? Well, here's how it works. Think of it like this way here. You have the lake, and then you have pipelines coming out of the lake, as I told you before. Let's say you want to, that goes to tech stocks, healthcare stocks, home building stocks, leisure stocks. So there's pipes coming out of that lake going to each one of these stocks. So these managers, okay, when they want to buy stock and they're going to buy tech stocks, money will flow through that pipeline. And you buy tech. And the lower the yields are, the faster that money goes through and the better the stock gets. So these pipelines, what are these pipelines? Who are they? Well, these are companies. Think of them as, like, for example, the repo market is a pipeline. Bank reserves, that's a pipeline. Dealer balance sheets, that's a pipeline. So all this money goes through the bank reserve, dealer balance sheet, all their balance, that's who the pipelines are. Just think of them as pipelines, okay? All those people who move money, they're the pipeline. The money goes through them to purchase stocks and bonds. And when they get clogged up, the market crashes. Well, and I told you yesterday, only 5 times in 25 years, the markets crashed. 2008, 54%, 2011, 20%, 2018, 20%, and then 2020, 34%, 2022, 27%. So now remember, that lake of money, that 50 trillion has stayed constant in that lake. So all these years that we had 54% drop, 20%, 34, 27, that lake had 50 trillion in it. So why does it crash? It crashes when those pipelines get clogged up or closed. When they get closed. And that pool of money can't reach the stocks, that pipeline that goes to stocks. Can't get through the pipeline if you want to buy home builders. Can't get through that. When yields are high, it clogs that pipeline up. When yields are low, the money moves fast. So what's important is not the size of the lake. The problem doesn't come from the size of the lake. As I said, 2008, 2022, the size of the lake, 50 trillion, the amount of money in that lake was constant. So it's not the lake that's the problem. It's the money flowing from the lake, from the 50 trillion, through the pipelines to the stocks you want to buy or bonds. That's where the problem is. That those lakes, those pipelines, do they get jammed up? Do they get blocked? And the answer is yes, when yields start going up. Example, as I said a moment ago, If you take the 2008 54% crash, the repo, that pipeline, okay, what happened? It froze up. Let's say the pipeline to tech stocks froze up. You couldn't get money through. Why? Because in 2008, repo froze up. The repo money. No one trusted collateral anymore. So at night, when banks got together to loan money to each other, they wouldn't do it. So it froze up. No one trusted the collateral. U.S. had a big downgrade in 2011. Boom, we went down 20%. Same problem. So I'm going to just stay a couple minutes here and finish this up for you, okay, because I think this is important so you understand, or I want to answer the question, will this tech rally just keep continuing? And the answer is it's up to that pipeline. And once you understand how the market works, you're going to be such a better trader. You're going to know what to look for. So 2008, the repo froze up. That pipeline, all the pipelines to the stocks froze up. 2011, 20% crash. Why? We had a downgrade. And we had a downgrade. They downgraded the United States credit rating. Funding tightened up. Boom, we had a crash. Why? The pipelines to tech, to housing, to healthcare stocks all clogged up. 2020, 34%. Remember COVID? All funding stopped when COVID started. That pipeline clogged up. And lastly, 2022, a 27% crash. Okay, now, remember what happened in 2022. Rates had to be increased by Biden. Remember, his rates were at 0%. It went from 0% 2022 to 450 points, 0 to 450 points, 4.50. Powell and Biden. Inflation went to 9%. So the market froze up because money couldn't get through those pipelines. Think of all these pipelines that are coming out, that lake of money that buys all these stocks. When those pipelines freeze up, that's when the market goes down. What freezes the pipelines is when yields, okay, get too high. So that's why stocks stop going through, or the money to buy these stocks slow right up. This is not a hard concept. Wall Street just doesn't want you to know it. That's all. They don't want you to understand how it works so you know what to look for. So that's why you don't follow the fundamentals. That's all BS. You follow the money. You follow the trend, the money trend, and we'll show you how to do that. But in 2022, when the market dropped 27%, remember inflation went to 9%, and what clogged up all the channels coming out of that lake to all the different stocks, again, was when they raised rates 450 basis points. Are you nuts? So when the pipes are open, lake of money, 50 trillion, pipes coming out, they're nice and clean, clear, boom, money's going through. Why? Because yields are down. And that's why you got to look at the 2-year Treasury, especially the 2-year Treasury. You got to have that going down. When that 2-year Treasury starts going up above 4%, it can clog up all these lines and you can get another crash of 20, 34%. So the market is easy to follow because all you have to do is follow the trend of money. So when the pipes are open and you got that 50 trillion going through those pipelines very fast because yields are low, you got a beautiful economy. You can't crash the market. In other words, how do you crash a market that has $50 trillion? It's nearly impossible. Unless, what happens? The only way the markets crash, okay, or you get a big correction, is through policies. See, every one of these policies, the 2008, 2011, 18, 20, 22, when those pipelines froze up, they couldn't get the money out of the lake to tech stocks. They couldn't get money out of the lake to home builder stocks, healthcare stocks. They couldn't get it out. Why? It's policies. It's the policies from our Congress, our Federal Reserve. When those policies are terrible, that's when you get bad things happen. Now, what's that mean, bad things? Well, that's when all of a sudden yields will go up, and then bang, the pipelines are clogged up. That's as simple as the market works. 50 trillion pipelines to all the stocks and bonds you want to buy, as long as yields are down. And when you see yields starting to go up, and like now, when we got the 2-year Treasury above 4%, you got to get that below 4%. And when you think we're just going to keep going, no, this market is not going up because of low rates in the 2-year or 10-year. They're too high. The market is going up because for now, the yields are holding steady. They're not taking off the 5%, okay? They're holding steady, so the money is flowing. And so money is flowing from the lake to the pipe to the tech stocks. That's all that's going on. So it's not a buying spree that's going on. See, many times people make a mistake when they think a big buying spree is going on. No, it's not. It's just that the pipeline, again, is clean. They can get money through it because yields are low. You got to watch that 2-year yield, that 10-year yield, okay, like a hawk, and you'll always know what the market is going to do, okay? It's not, remember, the market is easy to follow and figure out because it's money into the stocks, money out of the stocks. It's a channel. It's a trend. Always follow trend. Don't follow the jibber jabbers. Follow the trend. So again, the 2-year, only if the 2-year and the 10-year keep holding, this rally we're having in tech can keep going. So watch every day your 2-year and 10-year. And yes, the rally we're experiencing right now, tech, okay, can continue to hold. Stay with your best stocks, which are the chip, the companies that make the chip, make the machines that makes the chips, the semiconductors. I mean, those are not going to cover off the ball. They always do. So that's about it, okay? So again, it's all about watching your yields. And every crash we've had has been caused by a dumb policy. The biggest, dumbest policy was in 2022 under Biden and Powell when they kept rates at 0 for too long. Then when they finally moved it up 4.5 points, what do you think was going to happen? Not a crash? And then when they moved the rates up, the yields up, the pipeline's all clogged up. You're trying to buy tech stocks and the money can't move through the pipeline to get your tech stocks. You're trying to buy leisure stocks, the money's not moving through the pipeline. That's how the market works. It's that simple. So, but Wall Street doesn't want you to know that, okay, because they want you to depend on them. Just the same thing with all these stupid Japanese symbols they give you, like dojis and everything else, these sell and buy patterns. Are you kidding? Every time I used to look at those, my hair would burn. I mean, what the hell are those things? It was a system they used 300 years ago to trade friggin' rice. Are you nuts? And so stop paying attention to the fundamentals. Stop paying attention to those stupid Japanese symbols. Follow the trend of money. We'll show you how to do it. We've been doing it for about 50 years now, right? So we're free for 10 days, okay? Check us out. We'll help you. So, yes, the rally is only as good as how the money's flowing through the pipelines, and the pipelines are only as good as yields going down. That's it. All right, we'll see you on the charts tomorrow, and we'll see you on, hopefully, visit me again on my podcast tomorrow. See you on the charts.